Hi, everybody. Who does not want to build a finance function which is world class? I think every CFO wants it. But what is the right path to it? And that's exactly what we're going to talk about today with our excellent panel. So, welcome to the Mid Market CFO Circle Live. I'm your host, Madhurima Gupta. We launch new podcasts every Thursday on CFO Circle community. So if you're not on the CFO Circle community yet, you can join today. It's free access to your peer insights on technology trends, predictions, and the potential cost of not implementing automation and emerging technology to solve CFO office challenges on a regular basis. So to kickstart today's CFO Circle Live, let me introduce you to our panel of CFOs today, Blair Cook and Wayne Spivak. I'll start with Blair. He has held the position of corporate director at various organizations. He is an author as well. He's currently working as CFO of Mara Renewables Corporation. And Blair co-founded Executive Finance Partners in 2012, where he works with startups, growth and turnaround companies as advisor and executive. Blair has helped many companies to test the academic and real-world theories, practices, and will help us understand today by sharing his experiences. So welcome to CFO Circle, Blair. Thank you for joining us.
Pleasure to be here.
Next up, we have Wayne Spivak with us. He also has held various positions like that of a CFO, CIO, and COO across many companies in his 3-decade-long career. Right now, he's working as the CFO and president of SBA Consulting. He is also an instructor with Illumio Academy. Hey, Wayne, welcome. We appreciate you joining us today.
It's nice to be here.
So for our listeners, as promised, in this session, we will get tips from Blair and Wayne on how mid-market organizations should plan people, process, and technology to build a world-class finance function. So to get started, let's set some context. In the age of digitization, CFOs must act now to drive competitive advantage for their organizations, or they'll be left behind. So Blair, what or when, according to you, is the right time for founders of the business to hire finance leaders?
So founders of businesses typically will reach out to a CFO when they're ready to start scaling their business. And they're probably going to need capital. They'll need infrastructure. They'll need reporting. And that's probably the first time they're going to say, I need a finance person. And so in those early stages, I've been a CFO of a startup where there was myself and a founder. That was very early being brought in. But the impetus for that one was raising capital and going public very quickly. It was in a blockchain application. Other times you can go quite a ways because there's a lot of seed capital that might be spent over a year or two proving out a prototype. And you may not need a CFO, or certainly not a full-time CFO. You may just want to tap into a part-time CFO or a fractional CFO, and that might be sufficient until you get to that point where you need to build a financial presentation or raise some capital, or you start having monthly reports of financial results that need to be shared with stakeholders and users like banks and the like, and then you may want to think about bringing on a CFO. So you really need to have that critical mass behind your business before you're going to reach out and find somebody.
So Blair, if we narrow down on growing companies aiming to grow into enterprises, let's say in the next 5 to 10 years, right? Or even the companies that are aiming mergers and acquisitions. So for such companies, how would hiring a CFO early on help?
CFOs will be, helpful in terms of, there's a number of different things that CFOs can do that really adds a lot of value. We can do reporting, but to be honest, that's not the best use of a CFO. You probably hire a controller type to deal with the reporting stuff. And so, CFOs are really useful in terms of bringing that value-added skill that helps a business scale. And so scaling requires a couple of things. It requires building a team. It requires, putting processes and systems in place. And of course, it requires a skill to help the development and the execution of strategy. And that strategy could be through either organic growth or a business pipeline of products that they're trying to bring to market. Or some companies will accelerate that by using mergers and acquisitions. And so that's a part where a CFO will reach out with perhaps a director of corporate development or the CEO to identify targets in the sector, the desired sector, evaluate those targets, screen those targets, perform due diligence, negotiate the transaction, value the transaction, then bring it to a term sheet and a purchase and sale agreement, and then eventually integrate that acquisition into a business. And so again, CFO would be a key right-hand person for the team to make that happen and bring that merger and acquisition to a successful conclusion.
My next question is for you, Wayne. Post-pandemic, digitization has become a mandate for CFOs, but there is still a dilemma whether to accelerate business growth through digital initiatives or preserve or restore organizations' financial health by cutting costs. So, what would you recommend in terms of finding the right balance?
So you have a lot of wiggle room, as we like to say. It's taking a look at your budget and making intelligent cuts and reallocations. So when I talk to people about cash flow problems, sometimes you can increase revenues, but a lot of times you have to cut your costs. But cutting a cost is just not cutting costs. It's reallocating some of those savings to go back into productivity to help raise revenues. So for a business, you have to look at what technologies you need to adopt. I mean, you may not have a choice. You want to go sell to department stores or big box stores, and they use EDI. You don't have a choice. You must use EDI. But there are different EDI vendors out there at different price points. And if you're able to have some variance in who you could choose, sometimes you can't, then what you do is you try to find the most cost-effective solution. On the flip side is you can turn around and say, not everybody needs access to our accounting ERP system, so that we're not going to give you user access. And if there's a per user access fee, well, you've just saved some money. And not everybody needs it, even though they think they need it. So it's intelligent use of your dollars to maximize the effort to digitize or become more computer-centric. Also, by doing it the right way, you're able to decrease errors, and then you're going to save money on manpower. On most costs are payroll, salary, manpower. So if you're able to save money in configuring your systems to be more automatic, less user intervention, and you set it up correctly the first time, you don't have to worry about auditing everything that you have.
Got it. How about creating values in the long run? CFO inhibitions can have detrimental effects. Do you agree with that? Or is that something that you've even seen happen?
That's why you reforecast your budget on a monthly basis, or some decision made last month may no longer be valid with new information. A lecturer at Columbia University in New York, and I came in with a plan on how I was going to teach it. And I sort of did a poll of the students and found out that none of them knew accounting. It was for programmers who had to do with project management. So I had to change my whole lecture on the fly, which came back to an important concept that plans are dynamic, not static. So you have to be nimble. Companies that are no longer nimble have the greatest difficulty in sustaining themselves.
So Wayne, in that case, when companies are, let's say, today planning for what their finance functions should look like in 2025 and beyond, what would you say would help them to ensure the risks associated with, let's say, cost cutting today?
Today, more than ever before, especially when you use cloud-based systems, which used to be called client server, back in the day when I had a beard that was not gray, you everything now can be connected through APIs. So you don't want somebody to enter data 3 times. You want them to enter once, and through the magic of APIs, it appear in all the systems. So all the systems should be interconnected so that data flows. Somebody just asked a question on a Slack system having to do with they're doing consolidation, and they found that in their Excel spreadsheets, they're double counting and triple counting revenue. And my question back was, why isn't your systems doing the consolidation, which theoretically should allow you not to double and triple count, assuming, of course, you configured it properly, but that's always the case. So, you want systems that are interconnected, not siloed. Great examples. Salesforce seems to be one of the biggest and most complicated of the CRM systems. And I happened to be talking to a senior retail salesperson at this event I went to the other day. And once you get an order and it's confirmed, they move into most systems that order into the accounting system and the order entry system. That eliminates a lot of errors because the order itself, the items, the prices, everything has been agreed upon. It's sort of, which is the same concept behind EDI. The order moves in, it should be seamless, and you really shouldn't have to change the order once it's been accepted.
Coming back to you, Blair, there are a lot of cases where businesses start and the responsibilities you expect the CFO to shoulder are often done by a CEO. Do you think when a company is structured like this, there are certain areas that are left out? And will it be better handled by a finance leader instead, and why?
Yeah, certainly. It really depends on the background of the CEO. Some CEOs are very adept at raising funds and dealing with banks. And then some CEOs, true founders, are very technical because that's where they found a business idea. And so for those that are perhaps more hands-on, better at selling, better at technical, better at engineering, it probably behooves those kinds of CEOs to have a good, strong financial person by their side. It makes them well-rounded. But like I said, some CEOs are very adept at raising their own money, negotiating their own deals. And so I've worked for both types of entrepreneurs that are out there, and they can do both ways. And so for those ones, it's perhaps not as important to have a CFO by their side if they are financially literate or financial experts themselves. And sometimes they just need somebody to run the numbers for them. In which case you don't need to have as qualified a CFO. A good, strong controller can help them with just running numbers and making sure the financial reports are available. So it really depends, I think, on the competencies and the background of the CEO to determine, what and how soon they need to have a full-time CFO by their side.
So this also leads me to ask the next question. How can a CFO create value in an organization in comparison to a financially equipped or educated CEO?
So there's a lot of different ways that a CFO can and should be creating value in an organization. First of all, I always see the role of the CFO as kind of a strong number 2 to the CEO. We're actually looking for opportunities and bringing back that mission, vision, and setting the values of the organization. But the CFO really can add a lot of value because they take that input and they make it happen. They bring life to the vision, and that's usually the sorts of entrepreneurs I like to associate myself with. And you can have the most aggressive and assertive CEO out there, and you have the most conservative CFO out there, and makes for a nice complement, a nice mesh, because they complement each other in that way. And so one, sets the vision, and the other one executes the vision. And so that's probably the first way that they can add value to an organization. Typically, CFOs will add a lot of value in terms of the credibility that they will bring to an organization because of their financial background, their experience. They'll set up their reporting systems. They'll hire good people to be able to put credible reports out there. And that's foundational because that sets up the opportunity to engage with stakeholders, and whether it's with the board of directors on a credible basis, or with lenders on a credible basis, or even if you're trying to raise equity financing, or with capital markets on a credible basis. And so, typically your CEO would not have that same level of credibility as the CFO would. And so that's very often the second area that a CFO can bring value. And probably the third area, I'll only mention three, but the third area that we add tremendous value is around the cost of capital, managing cost of capital, which is through raising financing. And there's so many different sources of financing to raise today. And so it's knowing which sorts of investors to engage at which stages of a company's life cycle. So early stage companies will engage often with venture funds, whereas later stage, more mature companies will try to use more debt leverage. And whether they're doing it through private markets or through commercial banks, that really depends on the nature of the situation and the context that they find themselves in. So a CFO is usually well positioned to figure out what's the lowest cost sources of capital that are available, so that and that can add tremendous value to any organization.
Understood. Wayne, we just discussed the need to consolidate disparate system into an integrated system. Given the disparate systems can become blockers for CFOs to implement new technologies and silos and spread out of data repositories. This, to some extent, keeps CFO offices from building world-class finance functions. For CFOs struggling through these issues, what approach would you say can help their offices get right back on track?
That being said, is everything begins with a plan. And from the plan, you process what you're going to do. So that's business process mapping. You do a gap analysis, and then you execute the plan. So the plan then becomes the new plan, which is how are we going to go from A to B, which is gap analysis. And you start moving the data over, which entails dumping data from disparate system one and inputting it in to, we'll say, consolidated system two. And that takes time because of not only programming, but you need to verify. If you remember Ronald Reagan, when he was talking about the Russians, years ago, it was trust and verify. You have to trust the programmers did it right, but you have to verify your data. That's the number one thing when you put in a new system, is verify that the outcome is what you intended, not something else.
If you talk about order to cash cycle, what would you consider to be the most crucial process to be automated, and why?
The receipt of the order into the order entry system needs to be automated, if at all possible, because then there's error checking if the customer put in the wrong item or the wrong price. If you have the employee do it, you have another chance for an error manually. So there's two errors, because now they sent you a piece of paper, whether electronic or not, and you're manually entering it in. So they may not know the agreed upon pricing. It may not be in the matrix that's built into the system. So that's number one. That also frees up a tremendous amount of time. From order to the warehouse management system back into invoicing should all be automated. Obviously, as you ship, that's a manual process, but the flow of the information once something is shipped should be automated. Cash receipts is semi-automated when the money comes in. Collections is semi-automated. And let's go back to cash receipts. Why is it semi-automated? Because if you send out an invoice for $100 and they send $100, you have to match it up. But the systems nowadays will do a pretty good job of saying, does this look like this? Say yes, and you're done. But what if they send in $99? Now you have to decide what you're going to do. Uh, if you do e-com systems, and which all take credit cards, every day the credit card company sends you back a check that's net of discounts, and now you can have 50, 100, 500 different orders that now you have to match up. So again, a little bit more work, but it's manual to some extent. So that's the cash receipt side. Then the collection side, which is the ultimately end of the path when things don't come in, within terms, is high touch and high tech. High tech because you send out statements. That's automated. That's great. That's wonderful. If that doesn't work, you need a collector to make phone calls. You also need a collector to find out why you did certain things on your payment. Why is this deduction there? So you're never going to be able to automate that. Even though some of the, like I mentioned before, department stores will send you a notice, dig it out because their systems are really bad, and then figure out what they did. And you still have to make a phone call and go, why did you do this? Let me understand your thinking of why you took a chargeback or a markdown or whatever else you did. It should be automated in the processes that you're never going to get around the human intervention.
Blair, you've worked at publicly listed companies, investment management companies, and companies that were acquired. Through this range of experience and as growth-focused CFO yourself, what are the steps that have supported, what are the steps for you as a CFO that supported the business's growth?
The first thing I would say that we establish is you have to do kind of the nuts and bolts of finance and accounting. And it's not to say I don't do reporting, but I need to hire a really good team, because nothing will shoot me in the foot faster than if I don't have those processes in place, good reporting framework in place, setting up adequate or systems so that we can report things in a timely fashion. So that's level one. And then level two is really around trying to figure out what is the mandate of finance. And the mandate will depend on what is the business plan. And so if we're in a high growth industry and we're trying to scale quickly, well, then you're going to need to have a team with competencies that allow you to allow the business to scale. So again, if it's international business, having international tax, for instance, and having access to that, whether you outsource it or insource it, but thinking about all the different competencies that the finance function needs to deliver on for that mandate. If you're a public company, you're going to need to have some financial reporting experts. You'll need to have internal control experts on your team to deal with all those kind of regulatory matters. And so that's probably the next stage. And then the final stage is, I call world-class finance, which is gets back to this idea that we have to add value through strategy and strategy development. We have to add through value through data analytics, so that we're making smarter decisions. We have more predictability to our outlooks. And then I come back to the idea that, yes, we have to engage with capital markets and raising funds or fundraising aware. Even if we're not raising funding, we're always aware of what is the investment thesis, the investment story of the company, and our ability to raise funds. Sometimes even when we don't need it yet, it could be in the future. So always having that posture, that hat on.
Blair, in every job that we take, we learn what we do right and the mistakes we make. Are there certain learnings that you'd like to share with our viewers?
No, I've learned a lot. I've learned a lot of things. I've been 30 years into my career at this point, and so and I'm always learning. I don't even pretend to think I know it all. But I've been CFO 7 times. I've been on 3 corporate boards, and so I've seen a lot of different businesses over the years. And probably some of the key learnings. One of the key learnings that stands out in my mind was, I had recently got an MBA. This is 20 years ago, and it was my first CFO engagement. And I always thought everything was a strategy issue, and this was a turnaround company. And one of the directors came up to me and he said, Blair, yeah, this company may very well have a strategy issue, but it's the execution that's killing it first. And so in my mind, and that's fundamentally changed how I approach the companies I get involved with. And a number of them happen to be turnarounds. And so sometimes you need to do those basic processes that I alluded to earlier. And if you aren't doing that, don't even bother talking about strategy, because you don't have the credibility, you don't have the foundation built. And so that's why that focus on execution before strategy. If you don't do that, you're a turnaround. And it's interesting how many companies I've come to that have been around a while, and they all think they're growth companies, but yet they're not executing their own business strategy very well. And so until they've found what market niche, what value proposition that they bring to the market that makes them unique in the first place, there's no point in talking about mergers and acquisitions and organic growth strategies when they aren't even doing their existing business right. And so in a couple of these instances, these were turnaround situations, we shrunk the business. We shrunk it down to the profitable core, and then started talking about strategy and how to grow it. Because over the years, both of these businesses had gone after top line growth without meaningful increases in the bottom line. And so those were key learnings: execution before strategy. Probably the second, I'll only share two with you, but the second one is the importance of people. And there's been all kinds. I haven't gotten as far in my career. The organizations I've worked with haven't gotten as far and haven't been as successful without the people. And that seems like an easy statement to make, but there's so much that can be done on people management and leadership that you think is people take for granted, but it's very rare in the real world to see good people management and good leadership skills. And so, one of the mistakes I've made, very often you'll try to go out there and hire people who, may be the cheapest, or the people who maybe, you can train and develop people. I'm fond of this expression that sometimes you pay peanuts and you get monkeys. And so sometimes I go out there and I try to hire the very best people I can find. And sometimes I have to pay more for them, but I find they pay off in spades. And so I'm very conscious of talent, not only recruitment, but talent retention, talent development. And I think as a CFO, I am a finance guy, but that's become probably the secret of my success, is focusing in on the people. Because good people will deal with processes, good people will deal with systems, good people will deal with strategy issues. But if you don't have good people, you can't deal with any of those things. And so a huge amount of emphasis goes into people management, talent management, and leadership.
If you talk about cash posting, I think the process that is most manual is collecting checks. And when you have these checks, you have to map them with your remittances and then record the payments. So Wayne, this is a question for you. So in your experience, based on your peer interactions, which part of this cycle is most automated today?
Europe and in Asia, everybody's using wires. So while you might get a payment advance notice, you're waiting for it to come in the bank. The bank is accurate enough. All right. So in other words, it has the company name and it has the amounts exactly match up. The AI in a lot of the accounting systems today, from the low end systems like QuickBooks and Xero to the high end systems, be they Microsoft Dynamics, Sage, Intact, NetSuite, or SAP, JD Edwards, will match up your checks. And of course, the system says, is this? It doesn't automatically do it. And immense savings in time. So a lot of that's already being done. And with the advent of all these systems being able to read your bank account and download the data, you don't have to enter checks manually anymore. Mm-hmm. I remember you had to literally take the checks that came in the mail. Mm-hmm. Yeah. Nowadays, you could just add them up. You don't even have deposit slips anymore in the US. Mm-hmm. You just can scan them or bring them in, and they'll scan the individual checks and put a credit on your account in the bank. And then you just match it up afterwards, and you can look at which checks came in. Mm-hmm. So it's been automated tremendously to double check, because there are errors. Even on the flip side, with positive pay, which is a process to make sure that you, the company, actually wrote this check. because we've all been victims of attempted fraud. They make mistakes. It could be the check. It could be in there and they read the scanner read the check wrong. And they bounced the check and you want this check shouldn't have been bounced. The copy you're showing me is exactly what I wrote, and exactly what's in the system, but you still bounced it. So you always need a human being. That's why you'll never get, as much as one of the big topics in accounting is getting rid of accounting salaries because of AI. Yeah, you'll get rid of some people, but the percentage is going to be very low. Some of the clerks that you used to use, but so you'll go from bookkeepers or accounting clerks to accountants that are more trained that will be able to do some more analysis.
Understood. There are CFOs today who are looking to manage cash seamlessly. What steps would you recommend them to take so that their finance function can be on the path to success?
Your accounting system, if that's not clean, there's an old data cliche, garbage in is garbage out. Well, you're already going to get garbage in, so your cash flow management will be off, your runway will be off. So you need clean data, you need a good accounting system. Second is your budget and your forecasts. You really need, in my opinion, to forecast on a monthly basis. And the reforecast or the forecast, whichever way you want to look at it, is not as time intensive as the budget. It's looking at what information have you garnered and what has changed. In sales, that can move your different sales lines up and down. You may have had a price increase in what you were selling, or you might have a new estimation of how many units you're going to sell. So you need to do a monthly reforecast out for 18 months. So you're over rolling 18 months. And you have to understand that 3 months out is pretty accurate. 4 to 6 months is not so accurate. 12 months to 18 months is really a wild ass guess, a wag. After 18 months, you're kidding yourself. Unless you have contracts out that long, that's a joke. On the expense side, you know what your rent's going to be, and if you have a 3-year contract, you know exactly what it's going to be for 3 years. It's not going to change with the exception of maybe your share of taxes. All right, so you would find out what the taxes are and reforecast that part of your rent. Telephones, bills may or may not remain constant. TV is always a crapshoot. That's one of the areas that you can play with a lot and cut. Advertising is something where if you have a long-term advertising campaign, you might have a better feel for it. The biggest area and the biggest expense that you have, sans salaries, which needs to be reforecast every month because you constantly have different head counts and raises and whatnot, is if you sell a product, your buys. And your buys need to be adjusted and maintained based on your sales forecast. If you buy a lot of goods based on a 60-day turnaround time, and you're selling it in 120, you're going to have cash flow problems because you're not recouping your investment plus your profit. And this very important topic, or not a cliche, but a line: you can't spend profits. You can only spend cash. So now you have the two biggest inputs into your cash flow system, which is good accounting and your budgets forecasts. And then you need a system, and the best way of doing it is having an automated system, like a product like Dry Run, and there are others out there. There's called 17, there are a few others that will allow you to take these inputs in, and it will quickly calculate what your runway is. So it's always better to know ahead of time that you can run out of cash, because unless you have built-in lines of credit, it takes time to factor or get an asset-based lender or a loan from the bank or an investor, as the case may be. So you want to computerize it. Doing it in Excel is mind-numbingly slow because you have to enter all the data. I mean, some of the data you might have, your budget you're going to enter in through an import from Excel, but a budget is much easier than literally going there. What if you need to model and change certain assumptions? All right. If you have a system that does it, and all it takes is saying, okay, increase everything by 5%, and it does it, that's a lot easier than building it into Excel and changing a number, then going back and going back and going back. With some of these softwares, you just create a new forecast. It reads the same basic data in. You can put in the same budget, and then you can say add 5% to sales. You can make the bet, all sorts of things. So that's what I would suggest people do for cash flow. And it's one of the things that my company does for customers.
All right. Drifting a little on the other side, human resources play a major role in ensuring that you're building world-class CFO's office. That comes me to talk about the CFO's team. So we see that one of the key drivers for great resignation in general is the employee motivation to work, because often they are assigned mundane and laborious tasks. Do you think automation could be one of the things that can be implemented to solve this problem? Because automation can take away this mundane and repetitive work.
It very well could be. But I mean, at the end of the day, depending on the maturity of your organization, for many organizations, somebody has to put those invoices into a system. And that can be mundane and all that stuff. And so until you get to an RPA solution, robotic processing automation solution or something like that, somebody's got to put those invoices in. And so some of the ideas, like I with my teams, what I do is I set a roadmap, and once a quarter we have a strategy planning, and then we have once a year we have an annual strategy planning for the finance department. And on that roadmap, we have a 3-stage maturity model that we've developed. Level one is very much a compliance level, which is just, trying to get financial statements and processing transactions, just getting stuff out the door. And, through my own experience and through being a thought leader in the space, is over half of organizations out there live in this level one. And level one is not a fun place to be, because you're always just trying to keep up with the waves of invoices coming at you, just getting the statutory reporting done, filing the tax returns, filing the remittances. It's very administrative feeling. It's not adding a lot of value to an organization. But there's so many things that are coming at the finance function today, from the regulations to the legislations to the tax rules to the this to that. There's everything coming at us that we're overwhelmed. And so level two is trying to get control of that. And level two is, I use the analogy of a train with my own team as I talk about, there's, the caboose is level one. You're lagging the organization. You're just trailing. You're trying to keep up. Level two is when you get to become a passenger on that train. And a passenger means that we do have good processes. We do have adequate systems. We do have people who are competent, motivated, and we're in the loop on everything that's going on. So we're dealing with issues as they come up in real time, as opposed to leaving them till year end or quarter end to deal with them. So that's level two. And then world-class finance is level one. And that's where you're leading the train. That strong number two right beside the CEO. And a good CFO will have a team behind them that enables that to happen. And so those are kind of the 3 levels of making that happen. So the great resignation in my mind is like you have to tantalize people with the art of the possible. I can't do robotic process automation overnight. That's a big undertaking. It may take a year to transform. And so this roadmap, I call it the finance transformation roadmap. It can take, years to make this happen. At Mara, my current one, I've been there 4 years now. And we went from the day I started 4 years ago, we were a flat level one. And I have maturity assessment. There's 23 indicators, and you just say whether you're 1, 2, or 3. We were ones all the way down because we were an R&D company that was largely tracking costs. It didn't need much more than that. But as the company went through that R&D stage, is now commercializing, and now it's trying to grow globally. The expectation, the mandate has very much changed. And so I've had to figure out, how do I transform that finance function from just a back office into something, that's more value added, value driven. in its delivery. And so we've got this roadmap of all these different things. And generally speaking, the people who have been there, each year we see incremental improvements, and that gives people something to look forward to. It gives us something to always be working on. It gives people a career track. And whether you're getting a promotion or not, as the company grows, you grow in your role, you learn new things. And so I think this idea of mundanity of tasks, I think that if you are a static organization and you have that mindset that this is all there is, then I could see why people would get tired of that. Now, and then opposingly, if somebody has this opportunity that the world around us is changing and we have to adapt to that world, I firmly believe that accounting is in the news distribution business. Whether we like it or not, we live in a Twitter world. And accounting and finance over the last couple of decades has not changed that much. We still report financial results in 45 days or year-end results in 90 days. That doesn't align with the Twitter world. And so are we reporting old news or are we reporting real-time news? And then, of course, the other challenge is, are we reporting real news, or are we reporting fake news? And that too is a challenge in the finance. And so anybody who sits there and tells me that, there's nothing that we can do to improve and engage our people to be stronger, I think they're missing a lot of opportunities out there, because no matter what organization you're in, there's opportunities to adapt to what we see in the world around us.
All right. So now that we are at the end of the session, I want to understand and ask your parting thoughts for our listeners and viewers on lines of how you would recommend our listeners to build a world-class finance function that drives their businesses to success.
Some of the thoughts I've shared with you here today. Number one is it's about the people. So this idea that we're just finance people, and a lot of CFOs, we've all come up, we've all got designations, we've come up through the controller office or the finance function. But there's when you become that CFO, it becomes almost a big chunk of your job becomes leadership and talent management. And so recognize that, embrace that, because it is the secret to your success. The second idea that I think I talked a little bit about was this idea of a roadmap, a maturity model. I don't care what you call it, but it gives people the opportunity to look forward. And so we look forward 90 days, we look forward a year, and we also look forward indefinitely to determine what it is our mandate is and how we're going to get there. And I don't overwhelm my team by saying, listen, you're going to achieve this in the next 90 days or the next year. It's over years. The transformation gradually happens. And it's remarkable. Each year, our little needle is changing and getting a little more progressive, and we're getting a little bit closer to what our fulfilling the mandate that we've set for ourselves. And so I'd say that's a key thing as well. And then probably the final parting tip for the CFO is to recognize the opportunity to increase your value add in the organization. I think a lot of people, because of our backgrounds, a lot of CFOs are, CPAs or accountants or finance people. We rely heavily on the numbers, but it's the softer side of selling numbers that makes us influential, gives us clout, makes us powerful strategic thinkers. And so it's taking that data, it's taking those numbers and spinning them into stories. It's showing the impact of those things. It's negotiating. It's the soft skills that actually make you a very powerful individual. And a lot of CFOs, as they just get into that corner office, don't spend as much time or don't recognize the importance of cultivating all those soft skills like relationship building and team building and communication skills and leadership skills. Those are the things. I don't do very much technical anymore. It's all my soft skills and learning to use other people to communicate and deliver the message that make me effective as a CFO and a leader in an organization.
And when I say plan, I also mean look at your business plan. Look at your mission statement. And this is CFO can do with the other C-suite members. See if things have changed. Nothing's worse than starting off as a pure one brand e-commerce company, all of a sudden going up to 8 different brands, which means a lot more inventory, then selling white label and opening up an office halfway around the world, which wasn't part of the initial plan. So all the decisions based on the initial plan were no longer, I won't say valid, but would have been different. So you always need to reassess. And the best time to reassess is every month when you do your reforecast. It gives you time to see incremental changes and see what the CEO is thinking about and what marketing is thinking about and where you think you're going to go. And the CFO is right in with all those discussions because your job is to say no.
Great. I think this was an awesome discussion. So thank you so much, Blair and Wayne. It was great speaking with both of you, and I'm sure your inputs on this session will help CFOs build world-class finance functions. So thank you so much for your time once again. And for our viewers out there, you can watch complete episodes with our guest speakers on the link in the comments section. And we'll be back next month with another roundup of industry stalwarts and thought leaders. In the meantime, don't forget to subscribe to the Mid-Market CFO Circle community to never miss an episode. See you next month. Stay tuned.
Usually the number one priority in startups is to get money and get contracts in place. But the problem is that they're always hunting for the big whale or fishing for the big whale. Those big companies usually crunch you and have really bad payment terms. And so they have to keep track of those contracts, but they also have to be aware that they need some of these smaller to medium-sized fish out there to help pay the bills as things go along. And it's down in that space that I think startups can get in trouble.
I was reading some time back that if you look at the trend of how working capital metrics are evolving, right? As we're coming out of COVID, you'll see that DSOs are going up and the payable outstanding are going up. So some of the mid-market companies, you're going to face pressure at both ends. You're going to face pressure in terms of getting paid, and you're going to face pressure in terms of making payments, right? And we're moving into an economy that's going to be very different. Not totally different, but significantly different with all the hyper-personalization, the consumerization of B2B that's happening. Credit risk management becomes very important. Now, credit risk management forever has been a control function, right? It's about, okay, an order has gone on hold, let's take a look and see if I can extend some credit, let me push it forward. But that is no longer going to be sufficient because uncertainty is nowadays almost always around the corner. It's either a variant or a political conflict or a geographical conflict.
One of the things I learned a long time ago is if somebody touches something, every time somebody has to re-enter the information, you have a 5% chance of them screwing it up. Where if the machine does it, you don't have that chance. It comes through. Now, if it gets screwed up the way it got in there, then it's going to get screwed up. But you don't have, oh, look, I did this wrong. I mean, I know that I'm working here on something, and I was working on a great big report, and I got it all done, and then realized somewhere during the way, I had sorted it and scrambled it. So I have to start over.